Let's get ready for Monday Mortgage Minute with your hosts, Tom McNamara and Bruce.
All
Hello,
right.
Bruce.
Happy Monday.
It is. It has been Monday all day long.
What a busy week, too. I'm seeing lots of activity in there. It's really interesting. Let's talk about why, because some of it makes sense and some of it's not making any sense to me.
I think two things are happening. One, people are coming to the realization that interest rates are going to be stuck at 6 and 7% for a while, and they're no longer waiting, right? And houses have kind of flattened out for the most part.
I think so.
And sellers are willing to bargain a little bit. And so I think there's a little bit of that is good. And then on top of that, there's just some excitement in the air about the economy overall.
I think you're right.
I am a little concerned about this tariff pissing contest that we're having. I think ultimately it might be good. It might not be. I don't know. I'm not a economics expert, but it's definitely intrusive, right?
Well, there's always going to be some pain and some gain too. So I think a lot of it is probably more negotiation tactics than it is actually tariffs. And I think at the end of the day, we don't want to pay tariffs to Canada. They don't want to pay tariffs to us.
No.
They're thinking about the European Union going after them for tariffs. But I think it's a hard negotiation. And by God, in my opinion, we need it. We absolutely need it.
We do.
But it could cost Americans money when it comes to purchasing items, and we're already into inflation. So
I'm gonna equate it, Bruce, to working out. I don't know, how what your workout
what do you mean?
schedule
You don't
is
think
like.
I'm just a pillar of
So think about this though. Whenever you first start working out, that shit is painful. It hurts.
It's
right?
horrible.
And then it gets a little bit easier. Well, we're in that first 10 days of workout pain right now, and it might take a while, but we're going to get better, and it'll be better. Anyway, let's move on to the good news. You've got some bond news for us, right? Let's
take a peek at the bond charts here, because we want keep in mind, everybody, we want bonds to be up. So this is today. It started off high. We're a little lower than we started off, but I want to bring some really important things. So we want this to be up. We're trending in an upward motion right now. We can see that things were relatively flat Thursday, Friday, and Monday, but we broke above the 25-day moving average. We broke above the 50-day moving average, and we have pierced the 200-day moving average, but we've fallen below it. Now, here's what this means for folks. If we can get above the 200-day moving average, which is the strongest moving average, when you pierce that and you stay above it, you're going to start to see some improvements. And then the 100-day moving average is just slightly north of that. So if we can get above these averages, we are going to start trending in a positive direction. We already are positive direction, as you can see what's been going on here, but we have some room to grow, because if we go back and look at this chart, this is where we were before the first Fed cut. So we need to get at least back up to here. That puts us miles away from COVID, where we were up here, okay? Which I'm not expecting. But if we can settle somewhere maybe in this range, you would see rates in the low 6s and high 5s.
Makes sense. All right. Very good. All right. Well, hey, listen, I've got a couple of things that we were chatting about that aren't necessarily directly related to mortgage rates today and things like that, but what's going on in the overall market, and then what
the housing market
things are coming up, right? Yeah, the housing market, right? So we've talked about the lock-in effect for a while now, and I still see it, right? The lock-in effect is where basically people have gotten mortgages in the past, let's say 5 or 6 years, for 2, 3, 4%, and they're looking at potentially selling for whatever reason. And come to find out, the 6 and 7% rate that they're going to get today affects
It's too
their
much of a deterrent.
well, it affects their purchasing power, right? And how much they want to spend on a mortgage monthly. So they end up sticking with where they are.
Yep.
And so, that's obviously made it harder for people to, for somebody that's in a starter home to move up, which frees up that starter home for the next first time home buyer. The people it hasn't affected is the downsizers, at least not as much, because they're selling the big home and moving into the smaller home. But there's less people to buy that big home, so maybe they don't get as much, right? So that's what I'm seeing, but I'm starting to see that breakthrough. I actually had a client this weekend. You know who they are. They said no to buying a house 6 months ago, and now they're ready to rock, even though, frankly, the mortgage is going to cost them quite a bit more than it was 6 months ago. But simply because they're tired of their situation, they need to move up.
They need to move up. They're having children. He's gotten a raise, so he's making a little bit more money. So,
Yep.
that the world just worked in their favor, but we're seeing more and more of that. We had 2 clients that resurfaced actually over the weekend,
Yep.
that have decided to jump back in the market. So those are 2 people that backed away because they didn't like the payment 6 months ago. Now
And
they're having second thoughts about it.
even though the payments haven't changed much.
I think that's
So
pretty common.
I like some of these potential solutions that I'm seeing bandied about. I think they're interesting topics. You were a little confused when I showed you this one about government incentives for sellers, right?
Yeah.
So usually we see incentives for buyers, like, well, they give you down payment assistance or credits or things like that. But imagine if the government said to somebody that owns a home, hey, we'll give you X amount of dollars of tax credit if you sell a home, and how many more homes that might incent people to sell. And would it be worth it? Would it? I mean,
So
I'm not.
and here's the thing in our world, and I don't just mean the real estate industry. I mean, every single industry relies on the real estate industry. We are the key indicators of what the economy's doing. When we're selling a lot of properties, I guarantee you the guy that's selling cars is selling more cars. The plumber's busier, the electrician's busier,
Sure.
everybody's making money. But
Sure.
when we're not, no one's making money. So giving the seller an incentive to sell keeps properties churning and moving. And that's why money is called currency. It has to move. When money stops moving, it devalues itself. So we've
I
got to
like
keep
it.
that money moving.
That's a great point. And then the other one is, and I have talked about this for a long time. You said it happens occasionally, but allowing portability of a low interest loan. So if I get a loan today, and let's say I can get a loan at 6.5%. Let's say I'm really good and I get a loan at 6.5%. And then 5 years from now, I decide to buy a new home and rates are 12%. I can just go ahead and buy that house, move my mortgage to the new house. I would obviously have to make up any differences in cash and things like that, or potentially get a second loan. But if I didn't have to go ahead and suck up the higher interest rate loan in the future, that would be a great incentive to allow people to move and be mobile without being locked into that new interest rate.
Well, I think when you say it fast, it sounds good, but that would be no different if we switch it over and just say, um, you, the lender then is paying a higher rate of interest for their money. Because if money is selling at 12%, why would that lender have an incentive to lend you that money at 3 when they're now starting to lose money?
Well, for a couple of reasons, I would think. One is that they already lent the money, so it's not new money loan. You're doing a substitution of collateral, right? I'm substituting.
Yeah, but you're
collateral.
substituting a low rate for a higher rate.
But the loan is still in place, right? So the loan is in place. If I didn't move, they're still stuck with that loan. It's not like they can get out of it, right?
They are.
So they're stuck with that loan if I don't move. If I choose to move and they allow me to move that loan, at the same time, they're probably creating a new loan for somebody else. So it would allow that additional churn to happen where right now it's kind of locked in. I do understand
interesting concept, and I can see
I understand the
advantage.
counterpoint though, for sure. And obviously it would have to come with some fees, right?
And it would incentivize people to do that.
Yeah,
I don't know how
sure.
that would impact the mortgage industry. I think it
It's an
sounds
interesting
good when you say
conversation.
it fast.
It's an interesting
They've been
conversation.
doing it in Europe for a long time.
Have they really?
Yeah,
Okay.
they have.
I didn't
They've
know
been
that.
doing it in Europe for a long
But
time.
but they also have, correct me if I'm wrong, but in a lot of Europe, they have loans that have terms that reset every period.
Same in
Let's say
Canada.
5 to 10 years.
They call them fixed rates, but they're not fixed rates. They're like our 5-year ARMs or 3-year ARMs, where
Exactly.
you have to refinance, but you don't have to necessarily requalify, but you have to redo your mortgage every, say, 1, 3, 5 years.
Gotcha. Yeah, that's rough. I wouldn't want to get into that at all. So, so this one I don't really get a lot of. Like, I don't understand exactly why this would impact anything. And I think you agree that it may not. It was a double-edged sword, right?
Well, it's
Completely
gone back and forth
privatizing.
for years. Fannie Mae and Freddie Mac are really chartered entities of our government. They are not owned by the government.
Correct.
And I think we talked about the GSE, which is what government. Um,
Government-sponsored enterprise.
yes, and so they're still in control of the government. I don't know what benefits there would be to privatizing that. I don't know. I haven't
Yeah.
really put that much thought to it.
Yeah, that was one we came up with as a as an interesting topic, but
If you're
unfortunately,
listening to this right now and you have comments about that, feel free to text or send an email to Tom and I. We want to hear your feedback on that. What do you think? What kind of differences would that make? Would it benefit people? Would it hurt people when things become private and then you got stockholders involved and they want to increase their stock and
Mhm.
their income? So I don't know. I really don't
I
know.
don't know. Yeah. All right. So we got one more to cover, and this one actually has two different sheets to it because it's such a large thing, and
The
heck, this could be a
Sam's.
whole. So a shared appreciation mortgage, right? Again, this is something that I've seen in the investor world where, let's say I'm a lender to somebody buying a home that they're going to rent out to people for a while, and in exchange for giving them maybe a reasonable or lower rate on the lending, I actually take an equity position in the home as well, right? So I'm both a lender and in an equity position. I'm part owner of it, and that's
So
what
when
this
you
is, right?
sell that home, I get to share some of the equity that you gain
I get to share
because
some of
I
the
took a
appreciation.
loss on the interest rate.
Correct. So that's basically what it says right here, right? Buyer takes a lower interest loan or receives down payment assistance. Instead of the higher payments, they get a percentage. The lender gets a percentage of the home price increase over time. So it's kind of like it's kind of like partnering with mom or dad, but it's not mom or dad, right? It's another entity.
Yeah, I think there's another thing where it sounds good when you say it fast, but by God, now you got banks and now they're recording mortgages. And now are they liable for things if somebody gets hurt on the property
Hey,
because now they're an owner? And I mean, it just opens up all kinds of litigious issues that we could deal with. So,
clearly that shows up in the risks that we point out right here, right?
yeah,
Legal and financial implications must be clear. But you know the it's interesting, the dependency on the market, right? The If the home value declines, both the borrower and the lender have losses.
yeah.
So it puts the lender's in a good seat as long as there's appreciation, but they have potential loss just as much as the owner, right, of the home does.
So true. But if we look out over history, the chances on anyone losing money in real estate is few and far between. In the last 80 years, we've seen 6 times that there was not a gain in real estate. Two
Sure.
of the 6 were zero. So there was no loss, there was no gain.
Right.
4 of them were during the recession.
Right.
Okay. So, I mean,
Right.
we all knew what happened during the recession, and that was because of lenders giving bad mortgages to people that should have never got them.
Clear, right? So yeah, anyway, so it's an interesting thing to see, that there's options that people are looking at and exploring. Whether or not any of them come to fruition or become mainstream, who knows what's going to happen, right? But But clearly the housing market is a focus of the overall economy, to your point.
Most certainly
And
is. And I'm going to tell you something. I think the enthusiasm and the activity in the market has probably just since the election increased by at least 5 to 10% in activity. We'll see what that turns into closings, because sometimes when that happens, people come out of the woodwork and they're like, I want to buy a home and I got a 500 credit score and I don't have any money in the bank. Right.
right,
So we'll
right.
see how that works. And if there's really a jolt in the actual closing, that could take 2 or 3 months before those numbers actually start to come out.
Well, I
But
guess
we're
we will.
already seeing builder activity is up. Builders
Mhm.
are building more inventory, so they feel confident about the economy. And I think things are going in the right direction. And I'm okay with a slow, steady increase. We don't need this giant increase where everybody's freaking out, because if rates drop to 5.5% tomorrow, it would be a disaster, even though you and I would be busy as can be. Now buyers aren't going to be able to compete unless you got 20, 25% to put down. People are going to pay over ask price for the houses. So it's not healthy.
No, no,
We're over time, my
absolutely.
friend.
We are. Well, it's a great conversation. I hope you have a great rest of your week. And
And I'll get you
hopefully we
those updated pre-approvals